Welcome back to the Global Ledger. I'm Justin. In the last episode, we explored hedge funds. We call them the fast-moving, high-leverage predators and sometimes stabilizers of modern liquidity. Today, we shift to the opposite side of the spectrum, to institutions that barely move and yet move everything. We're talking about sovereign wealth funds, the quiet power brokers of global finance. These are the giant pools of government-owned capital that sit at the top of the world's balance sheets. They don't scream, they don't chase, they don't panic. They simply allocate slowly, massively, and with consequences that ripple through every market on Earth. By the end of this episode, you'll understand what sovereign wealth funds really are, where their money comes from, how they shape global liquidity, and why their moves matter to the global dollar system. Let's dive in. We have to start with the question of what is a sovereign wealth fund? A sovereign wealth fund, or SWF, is a state-owned investment fund built from a country's surplus wealth, is the best way to put it. So in plain English, it's the government's investment portfolio. These funds typically come from oil revenues, trade surpluses, foreign exchange reserves, pension contributions, or budget surpluses. The biggest ones, you may know, Norway's government pension fund, Abu Dhabi Investment Authority, Kuwait Investment Authority, that's another one. China Investment Corporation, and Saudi Arabia's Public Investment Fund. That's another big one. So together, these institutions manage well over $10 trillion. But what matters most is not their size, but their behavior. So these institutions matter because they sit in the middle of three worlds, basically. The political world, number one, is representing the state. The financial world, number two, really investing across global markets. And number three, the monetary world, holding reserves, dollars, in safe assets. They're not hedge funds or pension funds, and they're definitely not central banks. They are something different, and they are the long-term, cross-border liquidity anchors of the global system. When they buy for long periods, decades, really. When they sell, it reverberates across countries. So where does their money come from? Sovereign wealth funds exist because of structural national surpluses. So as an example, commodity surplus, oil and gas states. When oil revenues exceed the national budget, the excess flows into sovereign wealth funds. This leads to huge dollar inflows, giant treasury portfolios, and long-term investment in global markets. So trade surpluses is kind of the next one, important one to talk about. So countries that export more than they import accumulate foreign exchange, which is often recycled into sovereign wealth funds. This reinforces the global demand for dollars, the global recycling of U.S. deficits, and the stability of safe asset markets. And number three, fiscal surpluses. Rare, but powerful. Some governments use actual budget surpluses to build long-term savings. So unlike hedge funds or dealers, sovereign wealth funds move relatively slow, but they invest across public equities, private equity, infrastructure, real estate, venture credit, hedge funds, emerging markets, alternative assets, and crucially, U.S. Treasuries. They are the long-term buyers of global risk. If hedge funds are, say, the fast twitch muscles of markets, sovereign wealth funds are the bones. And let's look at their behavior during crises. So here's where they become truly important. They don't panic in crises. They rebalance. So think about Norway's fund. If stocks fall, they buy more. If bonds fall, they buy more. If private equity is down, they often add. Their mandate is long-term national wealth, not quarterly performance. This makes them counter-cyclical force multipliers, you could say. So when risk assets drop, hedge funds delever, dealers retreat, retail panics, but sovereign wealth funds quietly buy. This stabilizes the global system in ways few people appreciate. Let's maybe intertwine the global dollar system and sovereign wealth funds. We're here. So sovereign wealth funds hold huge dollar reserves. They buy U.S. treasuries, recycle global surpluses back into dollar markets, smooth global liquidity cycles, anchor cross-border capital flows. So in other words, they are essential to the functioning of the global dollar system. When oil prices rise, sovereign wealth funds accumulate dollars, buying treasuries, lowering yields. When oil prices fall, sovereign wealth funds withdraw dollars, selling treasuries, tightening conditions, right? So they are global liquidity sponges, absorbing in booms, releasing in busts. This has more impact on valuation than most economic data. Let's look at the difference between a sovereign wealth fund and central banks. People often confuse the two. There's some key differences, however. So central banks equal monetary policy, short-term, which basically means short-term stability, reserves management, liquidity support, interest rates, foreign exchange stabilization. Sovereign wealth funds equals investment policy. So long-term return generation, diversification, wealth preservation, and intergenerational planning, I would say, would be one of the last ones. A central bank reacts. A sovereign wealth fund anticipates is another way to put it. So one stabilizes the present, the other prepares for the future. So together they form the twin pillars of global financial power. Understanding these sovereign wealth funds can really, really paint you a big picture or add to the big picture. And take away these beliefs that big money, manipulates everything and institutions pull strings, behind the scenes. And yeah, there's some of that, but when you understand the core mechanisms of sovereign wealth funds and why they exist and what they do, what makes them powerful, what makes them productive. Their mandates are public. Their strategies are conservative, mostly. Their assets are diversified, and their impact really is structural. So they bring stability, not chaos, and order, in time, not panic. So this is the calm center of global capital, you could say. So I want to thank you for listening to episode 26 of the Global Ledger. We talked about a big player in global finance, and that was sovereign wealth funds. We call them the quiet power brokers. In episode 27, we're moving to another essential but invisible layer that I rarely hear talked about. It's clearinghouses. These are the institutions that keep markets from tearing themselves apart. Once again, I'm Justin, and thanks for being here.